In this video, I'm going to walk you through 8 powerful tax strategies that can dramatically increase the amount of wealth you actually keep in retirement. After years of working with retirees, I've learned something. Most people don't struggle in retirement because they didn't save enough. They struggle because once they stop working, they lose control of when and how their money is taxed. These strategies I'm about to show you don't require taking more market risk. They don't rely on beating the market, but they do require better timing and better coordination of the decisions you're already making inside your retirement plan. And when used correctly, these approaches often result in retirees keeping significantly more of what they've worked for their entire lives to build. So today, I'm going to break down all 8 strategies and show you why, in retirement, timing often matters just as much as investing when it comes to preserving your wealth. Hi, I'm Jay Forgione, President of Summit Retirement Solutions. We're going to cover 8 specific tax strategies, how they work, and why the retirees who use them consistently end up with better outcomes. Not because they took more risk, but because they planned for taxes instead of reacting to them. If you find this helpful, feel free to like, comment, and subscribe. Let's get into it. Strategy number 1 is strategic Roth conversion during low income years. This strategy means converting just enough from your traditional IRA to a Roth IRA each year to fill your current tax bracket without pushing into the next one. You're not trying to convert everything at once. You're deliberately using the lower brackets, typically the 12 or 22% tax bracket, and stop before you cross into the higher rates. The timing matters. This works best before Social Security starts and before required minimum distributions begin, stacking income on top of everything else. Here's why this is so effective. Taxes in retirement are about when income shows up, not just how much you have. If you can move money out of the traditional IRA at 12 or 22% today, instead of being forced to take it out later at a 24 or maybe a 32% bracket, or higher once RMDs and Social Security kick in, you've permanently lowered the lifetime tax cost of that money. For many people, the years between retiring and starting Social Security are the lowest tax years they'll ever have as adults. No paycheck, no RMDs yet, and more control over how much shows up in your tax return. When done consistently, year after year, this approach can save $150,000 to $400,000 or more in a lifetime taxes compared to waiting and reacting once required minimum distributions begin. Strategy number 2 is capital gains tax optimization. Capital gains harvesting is the intentional sale of investments in a taxable account during years when your tax rate or those gains are very low or even zero. When you're no longer earning a paycheck, your taxable income often drops significantly. That can place you into the 0 or 15% long-term capital gains bracket. Selling investments on purpose during these years, not because you need the money, but because selling allows you to reset the cost basis, can reduce future taxes when those dollars are eventually spent. For 2026, the 0% capital gains bracket applies when taxable income stays below roughly $49,400 for single filers and $98,900 for married couples filing jointly. Many retirees, especially in the early years before Social Security and RMDs, fall right into that range. When you intentionally sell appreciated investments inside that window, you lock in gains at 0% tax rate. That's not a deferral, that's a permanent tax savings. Over time, this strategy can transform a taxable account into a highly tax-efficient income source. Strategy number 3 is delaying Social Security while using IRA assets. Instead of claiming Social Security as soon as it's available, many retirees are better served by delaying benefits often until age 70 while using their IRA to fund early years of retirement. Here's why. Every year you delay Social Security beyond your full retirement age, your benefit grows by about 8% per year. By age 70, that's roughly 24 to 32% higher inflation-adjusted income for life. At the same time, drawing down your IRA reduces the balance before required minimum distributions begin. That means smaller RMDs, lower future taxes, and fewer surprises in your 70s and beyond. When coordinated properly, you often end up with higher lifetime income and lower lifetime taxes. Why don't more retirees do this? 2 reasons. First, after decades of being told not to touch their retirement accounts, using an IRA early feels uncomfortable. And second, claiming Social Security early feels safer. But when you zoom out, claiming early and leaving your IRA untouched often creates unnecessary tax pressure later. Proper coordination does the opposite. You use these years when you have the most tax control to draw from the IRA intentionally while allowing Social Security, the most valuable guaranteed income source retirees have, to grow as large as possible. Strategy number 4 is IRMAA management. IRMAA stands for Income-Related Monthly Adjustment Amount. In plain English, it's your Medicare premium surcharge based on how much income shows up in your tax return. When your income crosses certain thresholds, Medicare charges you more every single month for parts B and D. What makes IRMAA especially frustrating is how it works. These aren't gradual increases, they're cliffs. If you go over $1 over the threshold, your premiums jump for the entire year. For 2026, the first surcharge starts roughly at $109,000 of modified adjusted gross income for individuals and about $218,000 for married couples filing jointly. Every threshold you cross after that can add $1,000 to $3,000 per person per year to your Medicare cost. IRMAA management is the intentional process of keeping your income below those surcharge thresholds whenever possible. That might mean adjusting how much you convert to Roth, changing where your income is sourced from in a given year, or simply coordinating withdrawal more carefully. When done right, it can save retirees thousands of dollars every year without changing their lifestyle at all. Now, if you're thinking about how these strategies might apply to your specific situation, here's a link in the description below. We can walk through your income sources, your tax structure, and help you figure out which decisions actually matter for you. Strategy number 5 is spousal IRA balancing. In many households, one spouse holds a much larger pre-tax IRA or 401k than the other. That imbalance creates a specific planning issue later in retirement. The strategy here is to source Roth conversions intentionally from the spouse who holds the larger pre-tax balance. The goal is to shrink the account that will create the largest forced income problem down the road. Why does this matter? When one spouse passes away, the surviving spouse shifts from married filing joint to single filing status. The tax brackets get roughly cut in half, but the IRA balance doesn't. If most of the pre-tax money sits in one spouse's account, the surviving spouse can be pushed into a much higher tax bracket without much warning. By intentionally converting more of the largest IRA while both spouses are alive, and while the joint tax brackets are still available, you reduce future RMDs, lower survivors' tax pressure, and create more flexibility later. Strategy number 6 is qualified charitable distributions. If you're charitably inclined and you're over the age of 70 and a half, qualified charitable distributions, or QCDs, are one of the most tax-efficient ways to give. A QCD allows you to send up to $111,000 per year in 2026 directly from your IRA to a qualified charity. That distribution counts towards your required minimum distribution, but it never shows up as income on your tax return. This is different than taking a distribution, paying taxes on it, and then donating it. With a QCD, the money goes straight from your IRA to the charity, and you avoid the income entirely. This can help you stay below IRMAA thresholds, reduce taxable Social Security, and lower your overall tax bill, all while supporting causes you care about. Strategy number 7 is inherited IRA tax planning. Under current rules, most non-spouse beneficiaries are required to empty an inherited IRA within 10 years. That often creates a significant tax challenge because the inherited withdrawals land on top of the child's working income, often during their peak earning years. This strategy shifts who pays the tax and when. Instead of your child being forced to recognize large amounts of income at high tax rates, you intentionally convert portions of your IRA to Roth while you're alive, often during years when your tax rate is much lower. For example, if you're leaving a $1.2 million traditional IRA to a working age child, can result in a large portion of being taxed at the highest marginal rates. But if you convert $600,000 during retirement at 22% or 24%, that single decision can save the family hundreds of thousands in cumulative taxes. Strategy number 8 is tax bucket diversification. Tax diversification is the intentional process of building retirement income across different tax buckets: tax deferred, taxable, and tax-free. The goal isn't to guess which account type will be best in the future. It's to make sure no single tax outcome can derail your plan, no matter what happens. When your money is spread across these different buckets, you gain the ability to choose where income comes from each year based on the tax environment at the time. Tax laws change. No one can reliably predict what tax rates will look like 20 years from now. now. If your entire retirement income depends on one type of taxation, your plan becomes fragile. But when you have multiple income sources across different tax treatments, you gain flexibility. You can adjust withdrawals, manage brackets, and respond to law changes without disrupting your lifestyle. When you step back and look at all 8 of these strategies, they all have one thing in common. None of them require riskier investments. None of them rely on market timing. Every one of them comes down to better timing. When you withdraw, when you convert, and when your income shows up. Here's the key realization. You can't control market returns, but you can control tax timing. And the retirees who do better often didn't do anything crazy or exotic. They just planned for their taxes instead of reacting to them. So here's the takeaway. If you want to keep more of what you've built, these 8 strategies can help you do exactly that. Not by taking more risk, but by making smarter decisions about when and how your money is taxed. If you're nearing retirement or already retired and you want to make sure your financial strategy incorporates these kinds of timing decisions, let's connect. Click the link in the description below to schedule a conversation. We'll walk you through your situation and help you build a plan that protects what you've worked so hard to create. Thanks for watching, and I'll see you in the next one.